Good morning, everyone. I want to thank you for joining our webinar today. Hopefully you can hear me okay. I need to apologize for the raspy voice. So if you see me drinking some tea during the presentation, that's why I'm getting over it, but there's still something left. So apologies for that. So thank you for attending. If this is your first webinar, thank you for joining the series. If you've been here before, thank you for coming back. Today, I'm going to be presenting to you on various tax incentives, but during the presentation, I would like you all to think about possibilities. What would you do with this newfound money that you have? The incentives I'm going to be talking about are ways to get cash back into your pocket, and it's your cash. Instead of giving the cash to the government, we're going to show you how to keep it to yourself. So think about the possibilities during this webinar. What could you do with this newfound cash? So when I think about finding cash, it kind of makes me think about going on a treasure hunt. So that's what we're going to do today. We're going on a treasure hunt, and we're going to dig deeper and deeper until we fill up that pirate's chest full of treasure. It kind of makes me think about that commercial that's been out recently about sitting on a gold mine for insurance, selling your life insurance. She's sitting on a gold mine. Well, that's what a business is actually doing, sitting on a gold mine of all these hidden areas that can be explored for tax mitigation strategies. It's going to be high level. I promise we're going to keep it fun, for tax. And we're just going to cover the areas that will make you think about what you can look at further and dig deeper into the weeds later. So today, Daniel Plant is my director of marketing. He's going to be handling the webinar, all the technical issues. You don't want me doing any of that. So any problems, put them in the chat. Daniel will address them. And then also during the presentation, if you have any questions, please feel free to put those into the chat as well. So my name is Jill Mazur. I'm a director here at Engineered Advisory. Just a little bit about the company. We actually have, if you will, 3 legs. Engineered Tax Services. That's what I'm going to be speaking about today. This is where we've got all these various tax mitigation strategies available for you. We're a national firm all over the country and work with a variety of areas, and we're not going to touch upon them all, but just some very powerful ones. We also acquired back in 2020 the Growth Partnership. This is an amazing outfit to help our CPAs be better at being CPAs. So we've got marketing, leadership training, a CRM for our CPAs, a wonderful area to make you better at what you do. And then last year, we created what is known as the Advisory Accelerator. And this is a consortium, if you will, for our clients and CPA firms to expand their capabilities and to unlock additional resources to bring a lot more added value to your clients. Just a little bit about me. So I went to UT here in Texas, got my accounting degree and became a CPA working for Pricewaterhouse in Houston. And from there, I went to industry, traveled the world, and was with Oxone Petroleum. My suggestion is don't work in internal audit and travel the world if you ever want to settle down and have a family. But after that, I found this area of specialty tax incentives. And I'm very, very passionate about this because it helps companies get their money back into their own pockets. So let's go ahead and start our treasure hunt. And today, I want to start with kind of a real life example. I made up a company that's taken advantage of various areas that we're going to be covering today. And these are real areas and real benefits. So I used my imagination and called it ABC Manufacturing Company. But typical company, manufacture $20 million in annual sales. They have a 10,000 square foot warehouse. valued at about $1.5 million, and 25 employees. So with this company, we could actually look at the R&D tax credit. Most manufacturers do qualify for that. So we've got $2 million in qualified expenses, and I'll get into that later. And they were able to get a $393,000 credit. Cost segregation is a way to accelerate depreciation. We'll be talking about that. They were able to get $393,000 benefit on that. 179D, an energy efficiency incentive. They were able to get back $18,500. ERTC, employee retention tax credit, a $650,000 credit. WOTC, work opportunity tax credit, $53,000 plus in benefit, and an IC disc. That's a benefit for exporting, able to save $50,000 in tax. So this company, if they took advantage of all those arrows that we can throw into that quiver, could benefit at $1.5 million. And that's money they're keeping, not giving back to the government. So think about the possibilities of what you could do in having those funds available. So now we're going to go on our first leg of this treasure hunt, the R&D tax credit. This is actually my favorite incentive. It is extremely powerful and extremely misunderstood. So this is how I actually began my career, working with the R&D tax credit. And this is where people start to glass over, because when you say R&D, it just, people don't want to hear about it, but it's such a great incentive. So when you hear about the R&D tax credit, people think someone in a lab in a white lab coat, holding a beaker, shouting out Eureka. And that's what it was in the olden days. And now we're looking at the new days, and we don't need to have someone in a lab anymore. So what I tell people to do, which seems to help a lot, is to take off the R and look at D, development. What are you or your clients doing to develop their product or process? And that's where the R&D tax credit is hidden. So think about R&D as what is someone doing to do what they do better. And that's where we can look for the R&D tax credit. So let's continue our journey in looking for this treasure, if you will. And this slide is showing you not all of the industries, but a great many of the industries that qualify for the R&D tax credit. It is all over the place. I want to point out that manufacturers are the big boy. They make up about 70% of the 20 billion or so credits that are claimed from the government for the R&D tax credit. Next in line is software, the IT world. They make up about 17% of the credit. When you think of software, you think of someone writing software. But one of my largest clients was actually a bank. And most people go, well, how in the world can a bank qualify for the R&D tax credit? Well, think about all the software that a bank has to do what they do. Think about the apps you use on your phone for banking. That's all R&D tax credit. Additionally, I wanted to mention engineers. Most anything an engineer does qualifies for the R&D tax credit, and most every engineer thinks they do not qualify for the R&D tax credit. Engineers exist to be at point A. To come in, there's a problem, and they need to be at point Z. They need to fix that problem, and it's that path that we're looking at where that R&D tax credit is hidden. Some other examples, agriculture, when you're thinking about pesticide issues, yields per acre issues, all of that, how to get your product to market, you're figuring out how are you developing what you do to get it to the consumer. R&D tax credit right there. So just wanted to give you some examples of what we are looking at for the R&D tax credit. And it gets even better. So at the federal level, we can look at the R&D tax credit, but looking at this map, the green shows you every state that has some form of the R&D tax credit. So the benefit just got better. The treasure just got bigger. We get to look at R&D federally and on the state level as well. One of the best states in the country for the R&D tax credit is California. So they do have that going for them. So when we're looking at the R&D tax credit, we get to look at the current tax year. So the current tax year, if you filed your 22 taxes, is 23. So we get to look at 23 and the 3 prior tax years. So 22, 21, and 20. So let's just say a company was able to get $100,000 back for a tax year. So at the federal level, that's $400,000 current year, 3 prior years. At the state level, most states go back for those 3 years. So you've got the current year, the 3 prior years, which is now $800,000. And in California, you get to go back a 4th year. So that's another $100,000. So we've taken $100,000 credit and made that into $900,000. So just want to make you aware of how powerful this incentive can be to businesses, and think of the possibilities of what you would do with that. So want to give you a couple of real life case studies that we have for the credit to show you how powerful it is. So here we have a custom fabricator, and when we're looking at the credit, there's 3 items that we're looking at. We're looking at, well, first we're looking at, if you will, the activities. If you don't have activities that qualify, you don't have a credit. We come in, we will find those activities, we'll document those activities, and then associated with those activities are 3 items: the labor on those activities, any outside consultants you had to hire, and materials. So you're trying to make a new widget, the cost of materials, and getting to that unit of first production, if you will. So here we have a client. They had 1.9 at the bottom of qualified expenses. That's everything we threw into the bucket of R&D to come up with the credit. And the credit for this client was $193,000. That's their money that they are entitled to that did not go to the IRS now. Our next example, software developer in California. We were able to throw into that R&D bucket $4.5 million. And at the end of the day, they were able to get back $600,000. And if you look at that, that's 1 year. So it can be quite substantial, this credit. So not something to discount. And if you think you might qualify or not even sure, it's always worthy of a 5-minute phone call to find out if you do. When we're looking at the credit, I just wanted to give you some buzzwords. And these are when I'm talking to someone and they start mentioning these buzzwords, that tells me there's the potential for the R&D tax credit. So development, design, testing, modeling, all that is someone taking on an activity to make something better or new and improved. So R&D, fabulous credit, but let's look at the elephant in the room. And I should have put a big elephant in front of you. A lot of you may have heard that there's been some changes to how the R&D tax credit is calculated. The credit is not calculated differently. So I'm going to try to make a visual for you on this one. So what the new law says is that all expenses under Section 174 have to be amortized over 5 years. Previously, they were expensed immediately. We have to now amortize them over 5 years. The R&D tax credit falls under Section 41. So visualize a little balloon, that's Section 41, inside the bigger balloon of Section 174. Everything that's in that balloon has to be amortized, whether or not you are claiming the R&D tax credit. And that just is what it is. That is something that we have to do now. But if you're looking at the R&D tax credit, it may be even more powerful now than in the past, because what's happening is amortizing those expenses, it's really a hidden tax. And it's causing companies to have to pay more in tax. So this R&D tax credit could now be something that's even more powerful to you to try to offset those taxes. Always something to be discussed with your CPA, but I just wanted to make you aware of that. We are asking everyone that's impacted by this to please write Congress and to let them know that this is impacting you. And if you don't know how to get those letters to them, send them to us and we will take care of that for you. So just wanted to touch upon that because it's been in the news quite a lot lately. So R&D, I tried to keep it high level for you, nice, short and sweet. Just remember it's something to be looked at. So that's one arrow in our quiver of tax savings opportunities. We're going to continue our journey of treasure hunting, and we're going to go to cost segregation. Cost segregation really is a way to accelerate depreciation, and I'm going to give you a visual of what cost segregation is. So when you're looking at a building, everybody that owns a structure gets to depreciate that, which is great. It's a great way to help offsetting your income taxes with that depreciation expense. If we take that building and turn it upside down and shake it like a dollhouse, all these assets are going to fall out, and all those assets have a shorter life than the building itself. And those assets we can now group into different asset life classes. So if that building was being depreciated over 39 years, we now have a bunch of assets we can depreciate over 5 years and over 15 years. And if we have a larger depreciation expense, because now we're not stretching it out, every asset over 39 years, income minus a larger depreciation expense is a lower net income. And that's the power of cost segregation. We are segregating costs. And so I want to give you some real life examples of cost segregation. So here you see an apartment complex valued at 18 million, and in doing a cost segregation study, able to save them $1.5, $1.6 million just by changing the methods of how we're depreciating assets in that building. Here's an office building valued at 5.2 million, saved them over 600,000, and a hotel valued at 7 million, saved them over $800,000. So we're moving numbers on an Excel spreadsheet, all from that 39-year column to shorter asset life columns, if you will. So my next slide is showing you some of the items that we can look at for cost segregation. And it's not just new development. It is basically any structure that you have. And it can be several years old. A real example I have a client had a 16 or 17-year-old building, was actually my dentist, asked him who was doing his cost seg, and of course he had no idea what I was talking about. And we ended up doing a study for him and saved him another $60,000 or $70,000 on his building. So it's never too late to explore. And I did want to let you know that there's accelerated depreciation also that we look at, and basically great rules for getting a bigger depreciation hit, more bang for the buck. So we can take items that have a shorter asset life than 20 years, and we get to bonus that depreciation. Instead of taking it over 15 years or 5 years, up into 22, we can take it at 100%. We get to take all that depreciation at once, and it's starting to phase out 20% every year. So in 23, it goes down to 80%, and so on. But just wanted to make you aware how powerful bonus depreciation can be when you own real estate. This slide shows you some of those assets that fell out of that structure. So flooring, cabinetry, furnishings. When you take that structure and turn it upside down, this is what we're looking at. And our engineers will come into your building and take apart that building to figure out what is able to be depreciated on a faster level. For all of our studies, I did want to mention, we do put together a fabulous benefit analysis for you, and that will give you an estimate of the benefit, as well as our fee. And that is before a contract is signed, so you and your CPA can make an educated decision as to whether or not this benefit would be for you. So let's continue in our treasure hunt. Be thinking about the possibilities now, what you're going to be doing with this money, because that treasure chest is getting larger. So now I'm going to briefly touch upon some energy incentives. When you own real estate, you should also be looking at energy incentives. A lot of buildings, especially newer buildings, have become energy efficient. The government loves green, loves you being energy efficient, and they are going to incentivize you for being so. So right now I want to talk about 179D, a fabulous deduction. It changed beginning with the 23 tax year. We have a whole presentation on this, so I won't get into the details, but just know if you have a building, a commercial building, a great incentive to look at. And I'm going to show you how much it's gone up in value, or how much the benefit has increased. But not only a public or a private building, but public buildings as well. Government entities, nonprofits, religious organizations, they can qualify for this. And it's not that they can use the benefit, but they can give the benefit to the designer of that building, for example, via an allocation letter. So the entity that's not paying tax can share in that with the designer of the building. So 179D 22, that was valued at maximum $1.80 per square foot of that structure, if you qualified, if you met energy efficiency standards. Now in 23, that has changed, and that benefit has gone up to $5 a square foot, which is massive. Now, to get to that, you have to meet prevailing wage requirements, and you have to meet apprenticeship requirements. And if you're curious about what the prevailing wage is, if you're using union labor on your project, you are probably meeting that wage requirement. But you can always go to www.sam.gov to find out what that prevailing wage is in your location. So 179D, we also can look at 45L. 45L is another fabulous incentive. It is a credit. So a little different than 179D, which is a deduction. This is a credit. We can look at this for multifamily, residential. It is a very, very powerful incentive. The standards have increased of how it qualifies, but still something to look at for my construction people out there. If you are building a structure with rigid insulation, chances are you can benefit from 45L. But just another energy incentive for you to look at. The benefit on this was, before the rules changed for 23, was at $2,000 a unit. So you have a 100-unit apartment complex, that was a $200,000 credit. Fabulous benefit. That has gone up to $5,000 a unit. So the benefit is massive. In order to get that, you have to be at zero energy efficiency, which is difficult to achieve, and usually it's going to be on new construction. There are people that are at zero, they are building that way, but if you're at Energy Star, still a fabulous incentive, and you can see that benefit does go up to $2,500 a unit. And our engineers will test all the structures for energy efficiency. That's how we do our studies. We make sure that you do qualify. So that's kind of it on the real estate side of some areas you should look at. I want to talk about some areas to look at for the business itself. So employee retention tax credit. It's been in the news quite a while. So I thought it would be nice to touch upon it because it is going to be expiring, but a very, very nice credit to look at. So we can look at 2020 and we can look at 2021. And respectively, one will expire in 24 and the other in 25. Something to be looked at. The benefit can be up to $26,000 per employee. So we have a whole area that will look at ERTC for you. So if you think you might qualify, always something to be explored to add more treasure into that treasure chest. I did want to mention to you, and I'm sure some of you have seen some notices that have gone out, that the IRS has put the ERTC program on hold. On hold. They haven't ended it. It is on hold because they have a backlog now of over $600,000 of 600,000 claims to be looked at. And so they had to put that on hold. It's on pause until the end of the year. And it should be kicked back up at the beginning of the year. But don't think that it has stopped. It has not. When you are looking at ERTC, there has been a lot of fraudulent claims out there. So please make sure you go to a provider that is going to be around after the program ends. There's a lot of fly-by-nights out there, and I just suggest you to look for a trustworthy provider when you are looking at this incentive for your company. Another employee incentive is WOTC, Work Opportunity Tax Credit, a fabulous credit, overlooked all the time, great for manufacturers because they have a lot of people that qualify for this. You qualify for it when you hire certain classes of individuals, ex-felons, veterans, people on SNAP, all people that can qualify for the credit. We cannot look back. We have to start looking at employees as they become new hires for the firm in order to qualify them to take advantage of this. And the maximum per employee is $2,400, but with veterans, it can be up to $9,600. So please, please, please hire veterans. Always great to be able to do so. And so I just put that out there so you're aware of a couple of employee incentives. Next is the IC disc. I love the IC disc. No one knows about the IC disc. It has been around since 1971. The IC disc stands for Interest Charge Domestic International Sales Corporation. That's why it's called the IC disc. We don't want to say that whole word all the time. It is a fancy word or acronym for exports. So when you export, the government loves you to export. So they incentivize you for doing so. They do not incentivize you for importing, but for exporting. And basically, high level, what happens is when you export, the tax on the income of those exported goods is less than the tax on those goods being sold here in the US. So that's very high level, but just know that if you are exporting, something to be looked at. There was another export incentive called FISC, for those of you that may recall. That's gone, but the IC just still remains with us. And I have a feeling people think that all export incentives went. And I did want to point out, just to take you back 1 second, when you are looking at the disc, there's a couple of ways that we can determine that benefit of all that, those funds that are put into this entity, all those exported revenues. And one way is we can look at all of that as a whole and come up with the benefit at the end of the day, or we can look at each transaction. When you look at it transaction by transaction, each export that keeps sitting this disc, the benefits can be up to 4 times greater than looking at everything as a whole. And I won't get into the weeds, but if you have a disc, or you know someone that does, you need to make sure that they're looking at it by transaction, because they could be missing out on a lot of benefit. And we do it transaction by transaction. So just wanted to make you aware of that. And lastly, a great area that we have is grants. I hear all the time that people ask me, where I want to get a grant. I don't know how to begin. Even people I know a mayor of a city here in Texas doesn't even know how to go after the grants that he could be eligible for. So we have a whole area dedicated to grant writing for you. If you think that you have a new product, you're expanding, you're going to be creating jobs, you're going to be developing real estate, ask the question, ask us, is this something that could be eligible for a grant? Grants are a fabulous item to add to your capital stack. You don't need to pay a grant back. And you can get grants at the federal level, the state level, the local level, there's private. And we can listen to you, learn about your product or what you're developing, and pinpoint where we will look for those grants. So that's my presentation. I tried to keep it interesting. I hope you found it interesting. I hope that you understand that there are a lot of areas out there for tax savings. And I didn't touch upon all of the areas that we cover. So my suggestion is, if you think that there is something that should be explored, please ask us, ask me, ask someone who you're working with at the company, would this be something that I should look at? So at the end of our journey of looking for that buried treasure, we were able to put quite a lot in that chest, that buried treasure chest. So the possibilities, you've now got this money. And I love when I talk to businesses and they've told me they were able to hire a new employee. Think about what can be taken off your plate if you can hire a new employee to help with what you've got on your plate. Or maybe you didn't have to lay someone off, or maybe you were able to give out a bonus or increase wages, or whatever it is you were looking to do, you are now able to do. So think of the possibilities and think about all that treasure you now have. So I thank you so much for your time today. It's very much appreciated.